Here we go again. I've been on holiday for 2 weeks now, and I can tell you that was amazing. But I had to come back and update you what's going on the market, because that's really important. There are a lot of things is going on. So first of all, I'm going to check out just a quick update what's happened in the last 1.5, 2 weeks, and then let's have a look at what we can expect from the next week in terms of macroeconomic area. So last week we experienced, not only last week, but in the last 2 weeks, we experienced a couple of very important things. First of all, 1.5, 2 weeks ago, we received a unemployment claims, which was at the green line, not the last one, which is a little bit higher than the previous. It was a little bit on decline, but let's say that is consolidating on a very high way. And that shows us that the unemployment claims is still very low. So whoever is at work and taking the second or third job next to the priority job means they are really, really trying to stuck to their job, trying to not to lose it. But at the same time, we had a bad data as well. And that's the non-farm employment change, which is declining since 2021 in average. And despite the few spikes to the upside, that thanks for certain sectors of the market, we have a continuously declining data at 187K right now. It's a little bit higher than the previous, but the previous was revised, and that's why, but at the same time, the average is still declining. So the two data together tells us that there's less and less employment change in the United States, but at the same time, people trying to keep their job as much as possible. This can be working as long as the employee area is not damaged too much by the banks, but let's talk about that a little bit later. So we got the unemployment rate as well, and the unemployment rate is sticking to 3.5%, which is still consolidating on the same level, which proves the previous conclusion that there is less and less job, but people are trying to keep in their job as well. So it's very important to understand that when after that we got a CPI, and as you know, the year-on-year CPI got 3.2% after 3%, it started to go to the upside. The monthly CPI is on 0.2%, which is not too bad, but the yearly CPI with the 0.2% increase is talking about a lot of things. First of all, the CPI increased slightly, not because of the energy prices, but because of the food prices. And I made a video in June when I was talking about that there is a high possibility that the summer holiday rush is actually going to cause some kind of increased CPI at the end of the summer. Now, that would be fine, and regarding this, we probably can expect some more increasing CPI in the upcoming months, which is, by the way, the bad news. Whoever believes that the Fed is not going to raise interest rates, there is a very high possibility that they will, because if the summer holiday rush is accelerating the inflation to the upside, the next month's data will be just right before the rate decision will be most probably high. And therefore, the Fed is going to raise the rates with another 25 basis points at least. And still, we're not talking about the energy prices. So, very interestingly, motor vehicle insurance, 17.8% up year on year. Motor vehicle maintenance and repair, 12.7% up year on year. Tobacco products, 6.1% year on year. Food away from home, 7.1% year on year. And etc. All the food products is actually going higher and higher. So technically we can expect another CPI with a little bit higher reading, but at the same time we got the next week unemployment claims, which was spiking up a little bit. Now, at the moment we know that there is less and less job creating, less and less new job taken. At the same time, we got a quite steady unemployment. And if the unemployment claims start to raise, that could raise the unemployment rate for the next month as well. Now, what we see is that the unemployment claims data is moving in waves. And these waves is making higher and higher lows by each period. And if that was the last declining period, as we can see in the last couple of weeks, then if the increase is just starting now, most probably we are going to make a new higher high with this data. and the trend like growing is just started with this week. So it is a very important data. It's more important than the last 12 actually. And if we see that what data we got next, the core PPI is actually increased from minus 0.1% to 0.3%, means the producer price index is reflecting a very strong inflationary environment at the producer sector. And if we take a look at not the core, but the simple data, the simple PPI is also increased from 0.0% to 0.3%. So the producer data is under pressure, under price pressure, which means the retail next month most certainly will increase the prices. And therefore, the retail sales could decline in the next 2 to 3 months. So it's further slowing down the economy. Now, if we take a look how the market is actually reacting for this, we got a couple of news. For example, China's internet giant order $5 billion of Nvidia chips to power AI ambitions is a very interesting news because it's another $5 billion news from Nvidia. And we heard about the first $8 billion. It was technically a fake. And the big fish is not really reacting for that. What actually happening is that there is a plan that they will buy off $5 billion worth chip. For example, Baidu, ByteDance, Tencent, Alibaba, they are planning to buy $1 billion of these chips and another $4 billion worth graphics chipset. But the delivery time, or it's supposed to be delivered, in 2024. However, when I was investigating the Taiwan Semiconductor Manufacturing Ltd earnings report and the balance sheet, I did not find any pre-order or sign of pre-order for $5 billion. Or it's not exactly $5 billion, but even less. In fact, the TSM is losing revenue on a quarter basis. And that's a little bit worrisome because if Nvidia has a $5 billion business and wants to deliver it in 2024, they must produce those chips today. But the Taiwan Semiconductor Manufacturing Ltd, which is the only producer of the Nvidia chipset, is not reflecting this increased production. I think even if the order for $5 billion is not fake, it's not going to happen in 2024, maybe going to happen in 2026. At the same time, Joe Biden is stepping up for the American AI companies or against the American AI companies, but they need to stop these companies selling any products to China. So if Nvidia will be stopped to selling any products to China by 2024, this means that Nvidia needs to find another producer because obviously Taiwan is not Chinese Taiwan, but well, there is a slight chance that it will be within the next 1 year. So technically, it is a very strange situation, and I believe this is another fake news by Nvidia with the $5 billion. But how the market is actually reacting for that? As we can see, the S&P 500 is weakening. It's actually stalling since the beginning of the year, but mainly since the beginning of April. So the bull run, what we're seeing is actually a bear market correction only. And I know it's a bear market correction because there is no sign of big fish activity. Only the retail traders are driving the price to the upside. And this is somehow worrisome because if the big fish is not reacting just yet and only the retail, that means they're waiting for something. They don't believe to Nvidia. They don't believe to the AI companies that they will actually changing the world within 1 year when we have a complete economic slowdown and we can expect that slowdown in the next at least 6 months. So I don't think that this is the good message from the companies that, hey, I'm a good company as an Nvidia and take your money for a long term here. I'm not sure. In fact, put contracts are starting to pile up on the SPY and the SPX is pretty flat but still spiking to the upside with the put contracts. And the S&P 500 is about to break in its current structure. The structure which is driven by the retail traders, if it's breaking to the downside and the VIX is also breaking to the upside from its structure, it means there is a correction ahead. We do not know what the correction size it will be, but I can assume if the big fish stepping into the market with the correction, it could be pretty deep. If the big fish still not stepping into the market, the correction could be somewhat mild. But I'm not here today to decide whether how mild the upcoming correction will be at the S&P 500. What I'm seeing, if we assume that the next 6 months is not going to be very strong for the companies, producing wise. And I have a proof for this, because if we have a look at the gross margin plan for Q3 2023, this is from the Taiwan Semiconductor Manufacturing Ltd, it's actually between 51.5 and 53.5%. And the Q2 actual was 54.1%. So actually they are predicting a smaller gross margin, and the operating margin is also smaller because the actual was 42%, a little bit higher than the expected, but the guidance for Q3 2023 is between 38 and 40%. So the production is slowing down with the Taiwan Semiconductor Manufacturing Ltd, and this is important because that's one of the driver of the AI mania. So if people realize that the whole AI mania was a hoax, at least it's not happening just yet, they might start selling it. Now, if they are selling, where the money gonna go? And I think the best choice for any kind of market sector is the bond market. We see the iShares 20 plus year Treasury Bond ETF, which is the TLT. And as you can see, since 2003, this is the biggest drop ever we experienced on that chart. But there is a huge chance, due to the capitulation we are experiencing now, that this chart is actually trying to find its bottom. That doesn't mean it already found the bottom, but it's trying. And once this thing is trying, which is the biggest market ever on earth, all the money which could come out of the SPY, or at least most of them, could come back to the bond market. And I think this is a very good place to search for opportunities. If you need any details, just visit our website and take the opportunity on the Pro server. So once if you're in the Pro server, you will get so much information about the market that you wouldn't believe. So that is my idea according to the last 2 weeks and the last 2 years, that what is going to happen about. And now let's see what's going to happen in the next week. The Monday will be very, very mild. There is no major data coming out, so we can sleep very well. But on Tuesday, we're going to get a little bit of work. And this work is pretty busy. So in the morning at 1:50 a.m., by the way, this is all time what you see on the screen is Central European time. There is Japanese prelim GDP coming out, which we're going to have a look. And then 3:30 a.m. monetary policy meeting minutes from the Australians, and also wage price indexes. 4 a.m. is Chinese industrial production, which is really, really important. And retail sales also from China. And so all this data from the Asian sector will most probably aggressively moving the forex market in terms of the Japanese yen, the Australian dollar, and the Chinese yuan. And then in the morning, UK comes in with the claimant count change, very important, also with the average earnings index, which is a 3-monthly per yearly data, and also the unemployment rate. Now, the UK situation is pretty severe, and I would like to highlight that we are continuously following the UK's economic environment, because the first sign of a big problem came from here. And also, I think if we are dumping to the middle and we're gonna find the bottom economic-wise, this will be the first area which is going to show us where is the bottom. Then afternoon, 2:30, Canadian data coming out, CPI, median, trimmed, common, and core CPI. This is very important for the Canadian bank sector, which we know that the bank sector is actually driving the whole economy almost. And then also 2:30, US core retail sales, Empire State Manufacturing Index, and retail sales data. These retail sales data will not reflect what I just mentioned, probable retail sales slowing down. In fact, it could be rising because of the summer rush. But once the PPI going a little bit more higher, this could cause a destructed retail sales data in the next 2 to 3 months, as I mentioned. So it's very important to watching actually. So Tuesday will be very busy, and then Wednesday in the morning time, or at least for us in Central Europe, morning time, 4 a.m., 5 a.m. and 8 a.m. coming New Zealand official cash rate, monetary policy statement and rate statement, and then press conference, which is the most important, by the way, and then UK CPI and core CPI yearly data. That will be extremely important. And in the afternoon, United States industrial production, very important, and the US Fed meeting minutes. That's obviously we need to listen, because we need to figure out how the new data is driving the Fed decision right now. Now, don't forget that Jeremy Powell said a couple of weeks ago that they will need to see 2 of the data before they make in the rate rate decision. So that's just a driver, and I think it's a bad driver because increased CPI is never good. By the way, the energy price is also trying to increase, so it's going to be very bad for the CPI anyway. And then on Thursday, we're going to get Australian employment change in unemployment rate. Again, with the Australian dollar, this will be very important. And then United States unemployment claims and Philly Fed manufacturing index, 2:30 at the afternoon. Now, I don't wait too much from the manufacturing index because we know it's dead like a dead fish. But the only reason why I'm watching this data, because if it's making a surprise move to the upside, we will be very cautious in the market because that is really, really highly inflationary. And the unemployment claims, obviously what I was talking about, we are just waiting for the trend-like movement to the upside. And this will be a sign that the Fed is actually closing to a long-term rate pause instead of rate hike. So on Friday, it will be a very quiet Friday, finally, one. And we're going to get some UK data, retail sales at 8 a.m. in the morning. And then European Union final core CPI and final CPI. Now, this data doesn't really move the euro price index, but at the same time, I'm watching it because it's a very good economic indicator. And so compare the United States economy with the European economy. It's really important because there was time when the Fed is actually pausing interest rates and the ECB, it doesn't really like this scenario. And I would like to see the difference between the CPI numbers, how the two area is actually beating the inflation on a different strategy. So that's all it's going to be on the next week. I hope it's going to be very useful for you on the market. If you want to follow the market with us, with Forex, stock market, commodity markets, and the bond market and everything, just visit our website, get the Pro subscription, and on the Pro Discord server, you will get all the information where you just request from us. So see you there if you're coming. If not, see you in the next video. Bye.